Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Nano Dimension stock so we can determine if it's a buy or a sell. Nano Dimension is a 3D printing company, and as its name implies, its focus is on nanotechnology. Let's get started with the model. This is a small cap company, 746 million market cap. They're trading at $2.89 a share, and they have 258 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They're still not generating that much revenue at this point, so they have negative free cash flow every year, also negative net income each year. Revenue is the sales for the company, and that's gone up 1,500% from 3 million to 48 million, which is nice revenue growth, but it's still a really tiny number. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.9 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $1.2 billion. We divide that by 258 million shares, and we get a calculated stock price of $4.68. They're trading at $2.89, so they're trading at a 38% discount. It's a buy according to the model. It is really difficult valuing a company with negative free cash flow each year, so there's lots of assumptions built into the model. In a little bit, we're going to dig deep into the company's financials, and I think you'll get more value out of the video from looking at that than the DCF model. There are 38 companies in the computer hardware industry, and Nano is ranked 15th in terms of market cap. They're 746 million. The average is 5.4 billion. There's some big companies on this list. Dell is on the list. They're number 2 at 38 billion. HP, both companies have been around a really long time. The biggest is Arista Networks, close to 50 billion market cap. Nano spends a small amount in CapEx, 11 million in the trailing 12 months. Doesn't look like they have any debt. Their debt to equity ratio is 0. Still generating negative free cash flow. They do have a good price to book since they raised a lot of capital. Price to book is market cap over equity. Equity is on the balance sheet, it's assets minus liabilities. Another way to calculate price to book is stock price over book value per share. We can't look at their PE or price to free cash flow since they have negative earnings and negative free cash flow. They don't generate much revenue, so their price to sales is a bit weak, 17, which is pretty close to the average. They only generate 44 million of revenue, but their 5-year annual revenue growth rate is over 100%, which is the highest on this list. They recently released their first quarter earnings. Let's go through the entire report. Nano announces record first quarter results. Revenue of 15 million, up 43% over the prior year. Gross margins increased 44%. 50% organic revenue growth. Organic growth is the best and healthiest growth. That means the company does not use artificial fertilizers to grow their revenue. It's all natural growth. Nano is an Israeli company, but it looks like they have headquarters in Massachusetts. A leading supplier of additively manufactured electronics and multi-dimensional polymer, metal and ceramic additive manufacturing 3D printers. And they're intending to continue its share buyback program. Their revenue of 15 million is 43% over the first quarter of 2022, 24% over the fourth quarter of 2022. Gross margin improved from 10% to 44%, and they had positive net income for the first time, positive 22 million. Last quarter it was negative 87 million, last year negative 34 million. Adjusted EBITDA of negative 24 million, which includes 15 million of R&D. They had a $17 million cash outflow from their operational business. Last quarter was a $14 million cash outflow. Now the company had 3 consecutive record-setting quarters. Steady organic growth since July 2022. Since there are 6 months remaining in 2023, they hope to be ahead of the annual budget. One of the more exciting things this quarter is the fast adoption of their deep learning AI technology, developed by their Deep Cube division, which is now installed in their newer models of machines. And they're starting to receive requests from industrial customers to sell them the DeepCube AI engine. And these customers want that to be installed on their machines, not Nano's machines. And this is turning DeepCube into a standalone revenue-generating division. Their additive electronic business has been growing organically for almost a year, in spite of the continued crisis in the European economy, especially in the German, Austrian, and Swiss countries. Those are the DACH countries. Our AME, additively manufactured electronics, supported by impressive achievements in chemical development of dielectric and conductive printing consumable materials. We intend to accelerate our M&A strategy by carefully investing in assets that will create return on investment and value expansion for our shareholders, contrary to unprofitability, which is still a common denominator for many players in the AM industry. AM is additive manufacturing. They mentioned their tender offer to purchase Stratasys. And here's their tender offer. They plan to pay $20 per share for Stratasys. Nano already owns part of Stratasys, but they want to own more, close to 51% of the company. That's the goal. First quarter financial results. Total revenue for the first quarter were $15 million compared to $12 million last quarter and $10 million last year. The increase is from sales of the company's product lines. R&D expenses of $19 million. Sales and marketing was $7.5 million, down from $10 million. The decrease is from stock-based compensation and marketing expenses. G&A expenses of $11 million. That's up a lot from last year and last quarter. The increase is from payroll and related expenses, stock-based compensation, and professional services. Net income of $22 million or 9 cents a share. Nano Dimension serves over 2,000 customers across vertical target markets such as aerospace and defense, advanced automotive, high-tech industrial, specialty medical technology, R&D, and academia. They design and make additive electronics and additive manufacturing 3D printing machines. Their revenue in the first quarter was $15 million, and if they have 2,000 customers, that means the average customer spends $750,000. Let's look at the fun stuff, the numbers. Here's their balance sheet. This is as of 3/31/2022, 3/31/2023, and 12/31/2022. Let's focus on the middle column. That's the current balance sheet. $412 million of cash, down a lot from last year of $788 million. Bank deposits $573 million. Accounts receivables $10 million. So they sold product on credit. Those customers will pay them in the near future. $6 million of other receivables, $20 million of inventory. So $1 billion of current assets, down from $1.3 billion last year, down a little bit from last quarter. Their current liabilities only $34 million, so they have a really high current ratio. Their current ratio is 30, that's current assets over current liabilities, which implies they can cover their current liabilities with their current assets 30 times. They have nearly $1 billion of cash, because bank deposits is pretty much cash. You can just combine these two numbers. This $570 million may be like a 6-month or a 1-year CD, so they could earn a little interest on the cash. Then you have non-current assets. They have $160 million of investments, $10 million of PP&E, $15 million right-of-use assets. These are assets that are owned by another company that they lease. And if you go down to non-current liabilities, they owe $11 million on those right-of-use assets. That's their lease liability. The $15 million is the value of the asset. Non-current assets, $188 million, up from $111 million from last year. Total assets, $1.2 billion. They bought items on credit, $5.5 million. That's accounts payable. Other payables of $23 million. Total non-current liabilities, $16 million. Total liabilities, $50 million. Down from last year of $66 million, down from last quarter of $53 million. They raised $1.7 billion from selling stock. They bought back $20 million of stock. They lost $514 million from running their business. Accumulated loss is a sum of their prior net incomes. Equity of $1.2 billion. Equity plus liabilities is $1.21 billion, which equals their assets. Right here, $1.21 billion. Their accumulated loss last year was $340 million. Now it's $514 million. but last quarter their accumulated loss was $536 million. It's improved because they had their first positive net income in the first quarter. The difference between these two numbers should be their net income for the first quarter, or close to it. You see net income of $22 million. This is the bottom of the income statement, which should be the difference between these two numbers, or pretty close. Let's look at their income statement. Last quarter they had revenue of $10 million. This quarter, $15 million. All of 2022 was $44 million. If you annualize this quarter, 4 times 15, that's $60 million. So it looks like they are well ahead of the prior quarters. But they need a lot more revenue than $15 million. They need around $200 million to start generating real money. $200 million a quarter, not a year. But you got to start somewhere, right? And as long as they're moving forward, that's a good thing. All the expenses directly tied to generating the revenue are $8.3 million. This includes the cost to make the products and payroll. Revenue minus cost of revenue gives you your gross profit, $6.6 million. That's up a lot from last quarter of $1 million. All of 2022 was $14 million. $6.5 million is about 45% of this number. R&D of $19 million. Sales and marketing, $7.5 million. G&A, $11 million. They had an operating loss of $31 million, similar to last quarter. The only reason they had positive net income was this $57 million gain. This was a mark-to-market gain because they had to revalue their investments since interest rates have gone up. I would just focus on operating income. That's a better indicator of how the company's doing than net income. Because the stuff below operating income sometimes is not really part of the company's day-to-day operations. A lot of rookie investors may make a big deal about them having positive net income. You can't really count on this $56 million of financing income. That's not part of their business. That's just merely a blip. Let's look at their statement of cash flows. Statement of cash flows is the best indicator of how the company's doing, its actual cash. Even though they reported an accounting profit of $22 million, they actually lost $28 million of cash flow from their operational business, which is worse than last quarter of $21 million. The main reason is because they reversed out the financing income. That wasn't actual cash. That was a mark-to-market gain, a revaluation of their assets, a fair value revaluation. To put it simply, it was an accounting adjustment. It made their net income look really good, but it didn't improve their cash. And cash is how you run a business, not accounting profits. Let's look at the investing section on their statement of cash flows. They purchased $4 million of PP&E. Last quarter, they spent $18 million in the acquisition of some companies. Let's look at their financing section. They bought back $18 million of their own stock. I think this was their first stock buyback. And they probably don't need to buy back stock. They really need the cash to run their business. If they start generating positive operating cash flow, then they can buy back stock. But until then, it doesn't really make much sense. Another way to see how the company's doing is look at their EBITDA, earnings before interest, taxes, depreciation, and amortization. The way they calculate their adjusted EBITDA, they start with their net income of $22 million. They add back the D&A and EBITDA, depreciation and amortization, $1.4 million. They minus the interest income, so their EBITDA is $11.9 million. Then they have to minus the revaluation of $45 million. Then they add back other things like stock-based compensation. So they have an EBITDA loss of $24 million. And this is a much better indicator of how the company's doing than their net income. There's some similarities with EBITDA and cash flow. But I think by far, operating cash flow is the best number to look at. You should never take any number with a grain of salt, because you can manipulate any number to make it look really good by sacrificing another number. For instance, lots of companies make revenue look really good by sacrificing profits. They just lever up, scale and grow, take on debt, dilute the shareholders to grow their revenue. Since they're an Israeli company, they use IFRS. They don't use GAAP. EBITDA is a non-IFRS and a non-GAAP measure. Let's look at the stock on Simply Wall Street. Last price was $289, 732 million market cap. It's up a lot in the past week, up 31%, down 7% in the past year. Nano Dimension, together with its subsidiaries, provides additive electronics in Israel and internationally. Earnings have declined 62% over the past 5 years. Here's where the stock has been trading since 2015. They must have done a reverse stock split at some point, because the stock price can't start out at $100. Here's where the stock has been trading the last 5 years. So 5 years ago it was over $20. When COVID hit, it fell below $1. And then it had another big run up to about $16. That was in the beginning of 2021. But ever since that point, the stock has come down a lot. Here's some news and updates. First quarter earnings release, EPS of 9 cents. Nano commenced a special tender offer to purchase additional 40% in Stratasys. Murchinson urges Nano to refrain from undertaking any rash acquisition. It looks like Murchinson is an activist investor. They're trying to get the CEO, Yoav Stern, and Nano's board to stop acquiring companies without doing more due diligence. Murchinson is really disappointed by Stern and the board. This company, Murchinson, has been trying for a while to change up the board because the shares have declined 75% since Yoav Stern was appointed as chairman. It says here the company was founded in 1960. I didn't know it's been around that long. 564 employees. Nano had a price to sales of 10 in 2018. It was up to over 600 in March 2021, mainly because the stock price rose so much, but the stock price has declined a lot, so now that price to sales looks more attractive at 15. Simply Wall Street doesn't have a value for this company. There's no analyst price targets for this company as well. They had no revenue in 2015 and 16. They started generating revenue in 2017. At the end of 2017, their trailing 12-month revenue was $829,000. At the end of 2019, it was $7 million. At the end of 2020, it was $3.4 million. At the end of 2021, over $10 million. And at the end of 2022, their trailing 12-month revenue was $44 million. And their current trailing 12-month revenue is $48 million. Their debt-to-equity ratio is 0.09%, only $1 million of debt, and over $1 billion of equity. You can see historically they pretty much don't use any debt, and their equity has gone up a lot since they've been raising lots of capital. The CEO is making money. His annual salary is $800,000, total compensation $1.3 million. His tenure as CEO is 3.5 years. In the past year, there's been insider buying and selling. So you can see there's buys and sells. About 13 million shares have been purchased. 1 million shares have been sold. 67% of the company is held by the general public, 25% by institutions, and 6% by hedge funds. The biggest shareholder is Anson Group at 6.16%. They own 15.5 million shares. Cathie Wood's ARK Investment owns 1% of the company. In 2014, they only had 32 employees. By 2020, it grew to 92, but now it's a lot higher at 564. The ticker trades on the Nasdaq, Deutsche Börse, and London Stock Exchange. Let's learn more about the merger between Stratasys and Nano Dimension. It started out in the beginning of June when 3D Systems announced a merger with Stratasys. This M&A is unlike anything they have seen before. On June 20th, Credit Suisse issued a 7-page research bulletin on the rejection of 3D Systems and Stratasys. On June 27th, 3D Systems increases offer to buy Stratasys. 3D Systems is ticker DDD. They have a $1.3 billion market cap. Stratasys is ticker SSYS. Market cap $1.2 billion. The new proposal means each shareholder of Stratasys would get $7.50 of cash and 1.3 shares of 3D Systems common stock. On the same day, on June 27th, Nano increases its partial tender cash offer to acquire Stratasys from $18 to $20. The next day, on June 28th, Lake Street Capital Markets issues a 5-page report entitled Merger Mania Part 2, The Good, the Bad, and the Ugly. Then on June 29th, Donerail, who owns 2.3% of Stratasys, supports the merger with 3D Systems. On June 30th, Stratasys says the offers from Nano and 3D Systems are not superior to Desktop Metal. 3D Systems may increase their offer to $24 a share, but Stratasys has set a floor of $30 a share when combined with Desktop Metal. In past years, 3D Systems submitted multiple bids to acquire Stratasys, but the deal never went through. It seems like the merger between Stratasys and Desktop Metal has the greatest long-term benefits. The merger with 3D Systems has limited long-term results. Desktop Metal is the smallest company, ticker DM, market cap of $569 million. Let's look at some comments from Lake Street's report. 3D has increased its offer to $20.76 per share. Nano upped it to $20 per share, believed to be their highest affordable price, given their need to maintain cash reserves for their unprofitable operations. Nano attempted to bypass the Stratasys board by directly offering Stratasys shareholders $18 per share through a public tender offer, but this was unsuccessful, with only 8% of shares tendered. Nano owns 15% of Stratasys and needs more than 50% for controlling interest. The success of Nano's acquisition attempt is believed to be dependent on upcoming Israeli court decisions regarding the legality of Stratasys poison pill and a recent Nano shareholder vote to remove several board and management team members. If Nano loses either court case, the analyst predicts an end to their attempt to acquire Stratasys. But if they win both cases, the next key date is July 26th, when the tender offer expires. The analyst urges Nano to realize that institutional investors do not support their attempt to acquire Stratasys. A merger between Stratasys and Nano is not expected to yield the same scale efficiencies as potential mergers with Desktop Metal or 3D Systems. Stratasys has responded to the revised offers from Nano and 3D and appears to be going ahead with Desktop Metal. Let's look at this article, Best Under the Radar Stocks, 3 that AI predicts will soar in June. Well, June is over, but the 3 were Nano Dimension, Fiverr, and Palantir. Nano Dimension initially courted attention a few years ago during the 3D printing craze. However, the fanfare over the sector has died down significantly. Still, interest is starting to come back as the underlying technology improves. The company does have a stable balance sheet, with cash 57 times its debt. Also, it incurs deeply negative operating and net margins. Nevertheless, if you're willing to gamble with your AI predicted stocks, Nano may see upside thanks to its burgeoning market. Just be careful with this one. And this article was on June 11th. Let's see how the stock did since June 11th. On June 11th, it was $2.40. Now it's $2.89. So it's up about 14%. Let's see how these other 2 stocks did, Fiverr and Palantir. On June 11th, Fiverr was $29. Now it's $26. So it's down about 10%. Palantir was $15.65. Now it's $15.33. So it's down a little bit. Let's look at the article, Murchinson issues presentation detailing urgent need for change at Nano. Highlights company share price underperformance, terrible corporate governance, and poor capital allocation under the board led by Yoav Stern. Shares have declined 77% during Stern's tenure, and the company currently has a negative enterprise value of more than $400 million. This company is urging shareholders to make their voices heard and vote for the removal of 4 legacy directors and appoint Murchinson's 2 highly qualified independent nominees. This article was back in March, so about 4 months ago. Murchinson is the largest shareholder at 5.2%. Currently, Murchinson is 3rd largest at 3%. Maybe when the article was written in March, they were the largest. The first comment, the company has drastically underperformed. Nano shares declined more than 77% since 2021. Negative enterprise value of $400 million. Enterprise value is market cap plus net debt. A big reason they have negative enterprise value is because they're sitting on a lot of cash. The bottom line is that the longer the Stern-led board remains in place, the greater the risk of further value erosion. I'd be so depressed if I was Mr. Stern reading this. The board has overseen terrible corporate governance and failed to hold management accountable. The board and Mr. Stern are preventing the voices of shareholders from being heard. The board has launched a smear campaign against its biggest shareholder to avoid addressing the concerns about the company's extremely poor governance and track record. They adopted a poison pill against the express will of shareholders. A poison pill is a defense tactic. A poison pill is a defense tactic to deter activist investors and to try to stop companies from acquiring them. The board filed a dilutive registration statement to issue nearly 52 million new shares and commenced litigation in an attempt to declare the special meeting illegal and deprive shareholders of their right to vote at the legally scheduled special meeting. Adding insult to injury, most of the company's staggered board, including Mr. Stern, were appointed and have never been put to a vote by shareholders due to apparent manipulations of the director class system. Mr. Stern is characterized by a series of damaging capital allocation missteps. The board has continually failed to hold management accountable for its ill-advised acquisition strategy, poor integration of those acquisitions, and significant cash burn. We believe that Mr. Stern has used a string of acquisitions to mask the underperformance of the company, touting 2022 as a year of tremendous growth in the business, when the fact is that almost all the so-called growth came from expensive acquisitions, while the legacy business experienced no growth. Let's say we're a company and we acquire another company for $1 million. And let's just say that other company generates $500,000 in revenue per year. When you look at our income statement next year, you see an additional $500,000 of revenue, so you think we did great. But just because there's more revenue doesn't mean we're doing better. We may be doing better. We should see how much money this company generates, how much cash flow they generate. Let's pretend this new business generates $100,000 of cash flow for us. Revenue of $500,000, that implies expenses of $400,000. There's $100,000 left over. And let's use a discount rate of 10%. Let's apply a 5% growth to this new business. So if we use a dividend discount model, this implies the value of the business is $2 million in today's dollars. So it was a good acquisition. But what if the cash flows were only $20,000 and the growth was only 2%? Just because we have $500,000 more in revenue than we did last year is kind of meaningless because we're not getting much more money. We had to put up $1 million to get $20,000 of annual cash flow. And I'm growing at 2%. And of course you could play around with these numbers. If you say the growth may be higher, it may be 6%. But maybe it's a really risky investment and the discount rate is 15%. Or maybe it's not so risky and it's 7%. So you have to look at a lot of factors. If 2021 revenue for our company was $1 million and 2022 was $1.5 million, you may say, wow, we grew 50%. We're doing really well as a company. But if I said we spent $5 million to acquire this business that added $500,000 of revenue, then it might not sound so attractive. You have to obviously look at the numbers. But if I said we only spent $200,000 on this company and we got $500,000 of revenue because we integrated it into our company, then it's really attractive. So just because a company acquires another company which adds revenue doesn't necessarily mean it's a good acquisition. Let's look at that third bullet point. Murchinson is seeking to establish accountability and transparency and ensure the board prioritizes protecting value for all shareholders. They want to remove 4 legacy directors and add 2 directors from their own company. Murchinson believes a refreshed board can meaningfully enhance value. There are numerous actions outlined in our presentation that Murchinson believes could be immediately proposed and advocated for by the new directors to benefit Nano and all its shareholders. It is also clear that based on its track record, the board as currently constructed should not be the one making future strategy and capital allocation decisions, and that every day that passes without change in the boardroom increases the chance of further value destruction. Murchinson was founded in 2012 in Toronto, and this company is an asset management firm. Here's an article from March 21st, a couple weeks later. Nano Dimension shareholders overwhelmingly did not support Murchinson's proposals. Murchinson deceives, but the numbers don't lie. Over 90% of Nano Dimension shares not owned by Murchinson or Anson voted against Murchinson's nominees. The meeting and therefore the vote is invalid, and Nano shareholders should disregard any voting results released by Murchinson. I have a feeling this is not the last we heard from Murchinson. Leave a comment if you have more info on Murchinson. Let me know what you think of the video. Leave a like, subscribe, or comment below. If you want to get a custom valuation or support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.